Hello everyone and welcome. It's been a while. I hope you're all keeping safe and well. So thank you for joining us for the BKL year-end personal tax planning webinar. I'm Anthony Newgrosh. It's my pleasure and privilege to be your host today. And I'm delighted to be joined by my old friends Geraint Jones and
Hello
Chris
there.
Smith. Hi chaps.
Hiya.
And making their debuts today from BKL Wealth, delighted to welcome on board Craig Dowser and Ed Herman. Welcome chaps.
Good evening. Good afternoon.
Nice to have you on board. As always, we do welcome your questions and occasional facetious comments. So do type away. We'll do our best to answer any questions you've got either during the webinar, or our esteemed producer David will send out both a copy and a link to this webinar as a recording and a copy of the slides afterwards. And if there are any questions we haven't quite managed to pick up, we'll endeavour to deal with those and put a response in when we send those out to you, hopefully later today. So jam sandwiches at the ready. Let's get cracking. And we're going to start with a reminder of personal tax allowances at the moment. And I think, Chris, you're going to lead us off here. So away we go, Chris.
Yeah, so the point of this slide is just a general reminder, really. I mean we've all got some basic allowances that are there, and surprisingly, they will go to waste. Noticeably, where there's children involved and we've got opportunity for children to use personal allowances, that's one that particularly stands out. There's a bit of planning involved there, and equally the obvious one is when you lose your personal allowance, when your income's going over £100,000, it starts to taper away, and we will come on to various areas to try and reclaim that allowance. Obviously, you can see the basic allowances that are on the screen. There's nothing too elaborate on there. It's all pretty standard, and we haven't really moved for a few years now. So that's quite straightforward. The one part I would really say with this, just in general with the slides that we're going to come up with, we're trying to touch on fairly basic points for individuals. This isn't meant as a high-level tax planning webinar by any means. So it's just trying to get, hopefully, so that you can get some snippets of information just to make use before the year end, which ultimately is going to make you tax efficient. So I think with that, we'll just flip over to the tax bands. We've got a comparison from current year 21-22, just showing the change that's coming into 22-23. You see there isn't a change barring the dividend rate, which we're adding on 1.25%, which is essentially, you'll see in a minute, the NIC levy that's kicked in. So this is the hit on owner-managed businesses and individuals taking dividends. They've also got their share of the NIC levy, essentially. So it's avoiding just paying out a dividend rather than taking salary, etc. You're still going to get hit. Noticeably, you'll see, and again, we'll come back to the point later, the rate between 100 and 125 when you're fully taken away is quite a substantial tax hit at 60%.
Okay. So you talked there about NIC, Chris, and that's sort of the elephant in the room here, isn't it, with a 1.25%? Well, is it additional NI? Is it a levy? Well, over to you.
Yeah, well, I'm trying to remember when this came in now. It was how many months back. Obviously, there's been a lot of calls for this trying to be scrapped because it is actually quite an expensive rate. And initially, this does come in or officially this comes in as a national insurance increase for 22-23. And you'll see the differences there. And it's across on employer and employee. There's no cap on this, so higher earners are going to be hit with quite a substantial additional contributions. And from 23-24, the intention is to revert back to the 21-22 NIC rates, and then we'll have legislation showing that this is a health and social care levy. So from a payroll point of view, it will be identified separately. I guess the point where it'll be interesting to see whether we get some numbers back on is it actually going back into the NHS would be an interesting point. But at the moment it's there. It looks like it's here to stay. It's an extra hit, and ultimately we'll explore some ways to minimise the effect. Broadly, it's going to be salary sacrifice options, and we'll come on to that in a couple of slides' time.
Okay, so We touched upon dividends, salaries, etc., how to remunerate ourselves, particularly in light of ever increasing tax rates. Here's a little comparison we've done. How does it compare, Chris, if we're looking at remunerating ourselves?
Well, I mean, it's for us. This has been a chart that hasn't really moved for a few years now. It's always it's been more cost effective to be self-employed, and it's usually better to take a dividend via the salary. And you know that's we thought that was the same, and then I think when you flick to when you see the new NIC stroke levy, when it kicks in, the gap between the dividend rate and the salary starts to close up.
So that's for that's for 23-24, and also the other key point here, Chris, is the increase in corporation tax rates, which is generally not good news, but you are getting a higher tax shelter on your salaries, and hence the differential between a dividend and a salary very much narrows from 23-24 onwards.
Indeed.
But I think we should just highlight, although yes, we're here to talk about tax minimisation, there are other factors here. For example, as you said, we'll come on to pensions later. If you're talking about paying pensions, etc., you may need a salary in order to ensure you can get tax relief for that. If, for example, you're doing R&D, it may be possible to claim enhanced R&D tax breaks on salaries. You don't get the same relief if you take your remuneration by way of a dividend. There's also cash flow, isn't there? Dividend taxes are payable generally after the year end. So it's not simply a case of the ultimate effective rate of tax there. There are some other factors we should also consider and look at this in the round, is I think the point we would just highlight there. Okay, so those are the tax rates. Let's start delving into what we can do by way of tax efficient investments. And let's start, if we may, Ed, Chris, over to you guys. Let's talk about ISAs. Yeah,
I mean, again, the point here is we've got allowances, and we can make use of those allowances, and ISAs are still efficient. And I mean, I'll hand over to Ed, because I think there's points that we normally see. We would just say, as tax advisors, to make sure you top up and use your allowance, but I think the investment planning on it can be, not neater. The reason why do we top up?
Absolutely, Chris. I mean, paying into your ISAs if you can, 20,000 a year. If you've got a partner, trying to maximise for them as well. And the reason being is when you come to draw down your income in retirement, we have the same allowances when we hit retirement. And the great thing, obviously, about particularly stocks and shares ISAs, if you get the investment return, but you can take your income without paying any tax. And ultimately, when you're drawing down in retirement, and if you've got a fund, what you don't want to be doing is drawing out money from the fund to pay tax, because it puts a much greater stress onto your portfolio. And obviously, as you're taking income, if the markets take a slight dip at that point in time, and you're having to pay a bit more out, it can be harder for that portfolio to sustain itself. So build up the pot while you can, because it basically you end up with very, very little tax, or no tax to pay in retirement on your ISAs. Use your cash also from your ISAs potentially before you draw down from pensions. And at the same time, you've got junior ISAs in the portfolio. It's a great way to build up savings for your children. The one thing I would say and bear in mind is when your kids hit 18, they have full access to your ISA at 18. It doesn't become a junior ISA, it converts to a full ISA. So you need to trust your children at that point, because if you build a decent sized pot up, they could draw out chunks and do what they want, and you cannot necessarily stop them doing it because they have legal rights to the money.
Yeah, I think I agree with all of those points. I think one of the things that Ed touched on there is that the ISA should form part of overall retirement planning, because not only is it there for you to grow your assets while you're building up towards retirement, you can have access to it at any point in time. But when you start to take money out, it gives you the ability to draw cash or draw funds from tax-free environments alongside your pension, where you're getting a proportion of it's taxed. And the government brought in this lifetime ISA, which is basically formed for two purposes: one, to buy a first property, or two, for retirement. And a lot of people miss out on the lifetime ISA, which gives you a 25% uplift on whatever contributions you made. So for the younger people under 40 saving into those, it gives a good advantage to get an uplift of 25%, which would be more than the gains you probably achieve in a normal return. And you can't access it till 60, so that's where it really shows that it forms part of that retirement planning. One other bit that I'd just say as a snippet of information is if you're worried about the investment markets at the moment with everything that's going on, then you don't necessarily need to fund money into a stocks and shares ISA and it be invested, but you could put that into a cash ISA now, make sure you've used your year's allowance, and then always move that at a later date. But the ISA allowance is one of those allowances that if you don't use it, you will lose it.
Yeah, no, I think that's certainly very relevant in the unfortunately current uncertain times. All good. So ISAs, we sort of tend to think of as one, don't we? But there's a number of subcategories there, and we should consider them all carefully, particularly as you guys have referred to, where there are kids involved. So those are ISAs. Geraint, do you want to just give us a heads up on the sort of planning we might want to think about if we're self-employed?
Thank you. Self-employment is one of the areas which is due to change. And by self-employment, I'm also including people who are partners in partnerships. The risk of getting too technical at the moment, if you are self-employed or a partner and your year end is say 30 April, then your tax assessment for the year to say 5 April 2022 will be based on your profits for the year to 30 April 2021. So you have quite a long period before you actually need to pay the tax on the profits that you've made. Unfortunately, that is about to change. And with effect from 23-24, which is going to be a transitional year, we're going to move from what was called a current year basis of assessment to a tax year, which means you'll need to apportion your profits so that in your tax return, you're putting down your profits to 5 April or 31 March each year. So that means in 2023-24, there's going to be a big transitional year, whereby to take my example of 30 April year end, you are going to have to put down on your 2024 tax return all the profits that have arisen between 1 May 2023 and 5 April, so 1 May 2022 and 5 April 2024. So you're going to end up with pretty much a 23-month period of assessment taking place there. Now you're going to be able to set your overlap relief against that profit, and you are going to be able to spread that profit for up to 5 years. But it is going to mean that you'll be paying tax much sooner after the year end. So this raises certain questions as to what planning can be done around that. And I think one of the planning issues you can take is to make the decision as to whether you want to change your year end a year early, so that you would potentially set overlap relief against a higher profits if your profits are due to dip quite considerably. This is very much going to need to be done on a case-by-case basis. So if you are likely to be in that pot, do have a word with us, and we can take a look at it and see whether it'll be worth your while to do an early change of year end to 31 March. So we remove this sudden spike, or at least have it spiking at a different point.
Okay.
Yeah,
I can see this is all. Go on, Chris.
Sorry, Tony. One of the other bits just really to pick up there, we often miss the cash basis with individuals that are self-employed, relatively small turnover below 150,000. You've got the ability to delay, whether either bring forward some expenditure or delay it, push it back into a latter year, or bring it forward again. If you're going to bill a bit early and receive money a bit early, again, you can play. You've got some scope. You've got a little bit of movement. So if you are in a lower band in 1 year and a higher band, expecting to be a higher band the next, then you want to obviously catch more income in the early year. If you're higher in the current year and you're expecting it to decrease in the latter year, push it into a later year, or look at it from a cash flow advantage or disadvantage. So the point is there's bits to play around with this self-employment. And as Geraint alluded to, year-end changes as well is one that should be considered.
All right, thank you. And it's interesting, we touched upon the increase in corporation tax from April next year, where there are sort of corresponding considerations. Do you want to push expenses back if you can into a year where corporation tax will be 6% higher, and almost that's a topic in its own right, and we'll think about that for a future webinar to explore further those points that you've raised. But let's go back as time marches on to tax efficient investments. There's plenty out there. Craig and Ed, do you want to give us a heads up on some of these points?
Yeah, absolutely. And it's interesting that the top line there is about income versus growth oriented collective investment. The point here is a lot of people, if you self-invest, you often pick funds. The question is, do you have the experience to make sure that you're actually picking the right funds for your actual current scenario? So if you're in a scenario where you start a retirement, there are a lot of investments that will generate what's called natural income, dividends. And to drill down within those funds to understand that can be quite tricky. And what we find is certainly talking to people who have substantial funds and looking to rebalance their portfolios, the use in this scenario of specialists such as discretionary fund management is really, really useful. They have a huge experience in how to balance out your portfolio, and they will move it around and tweak it to ensure that depending on where you are, whether you want growth or income, that the underlying investments match up with your goal. They also at the same time will manage your capital gains tax. So depending on your personal circumstances. And it's interesting because a lot of people will do it, well, I can pick my own funds and do my own investments. But I recently had a client who we had a meeting, and their actual son was in investments, but he wasn't a discretionary fund manager. He worked for a private investment house, and he joined the meeting, and he was very impressed with the way that the discretionary fund management was structuring the investments for his mother. Clearly had a lot of interest in making sure her future will be secure. And it's really worthwhile looking at that, not just go, well, I can do my own stuff. It takes a lot of time. The discretionary management companies have a huge resource, specifically to research companies. And when you get into periods of volatility, having someone there where you can go to and engage, which they're more than happy to do, is absolutely fantastic. And it gives a lot of reassurance to clients in terms of your investments. The investments underlying that will be very similar to what we've spoken about, the ISAs and general investment accounts. And we also look at investment bonds, as you can see there. And investment bonds are very much a tax planning tool as well as an investment tool, because generally we utilise offshore bonds for this scenario, and they sit obviously outside the UK, and you get gross run-up, therefore you don't pay tax on the gross. So the fund will grow better. What also you can do, align that with a discretionary fund manager, you can, if you're intending to retire, say, not to the UK, they will do potentially dollar investments. So if you want to draw your income down in the future in dollars, rather than having to then suffer exchange rate fluctuation at that point, they can invest you in dollars the same way. And I've done a case very similar to that recently as well, where the client is about to leave the UK, we set the bond up in dollars so they can draw their income in dollars going forward. You can also, at the same time, investment bonds that can be assigned. So if you've got kids who are particularly going into university, you can then do a chunk of the bond because they attract their own personal allowance of 12,570. So rather than, when you bring an offshore bond back on shore, you would normally get taxed at your marginal rate if you do that. If you assign it to a child who's got no income, they can get £12,500 a year gain back tax-free. And they can use that towards university fees or whatever at that point in time. And again, I've used that strategy in the past, and it works really, really well.
Yeah, I've seen that used a lot as well for school fees in general, even whether it's grandparents just assigning or gifting money into a bond that then allows them to fund their children's school fees. And these are all things that we can help with. I mean, from looking at the premium bonds point on there, one of the things, cash market's pretty poor at the moment. There's not necessarily great returns, but what we always want people to do is keep an emergency fund. And an ideal place to keep that is somewhere where you can access it, and it's always going to be guaranteed. So premium bonds are backed by the government, and therefore your capital you're not going to lose your money. So the way that those work, you can have £50,000 for an individual in there, and every month, if you're lucky, two people will win £1 million. So you might not earn that much return, but your money's safe, and you've always got the opportunity to win £1 million. And as I said, two people get that each month. And that prize money, because it's prize money, tax-free. But I'd like to touch on some more kind of tax-efficient investments. And now I just want to caveat this and say that they're not necessarily appropriate for everyone, and they are also open to kind of legislation change. But one thing we see at the moment is where the regulations around pensions and what you can fund into a pension have changed and has impacted on higher earners. VCTs and EIS investments have become a lot more prominent in the market. And these types of tax efficient investments offer people the opportunity to put money in, invest it with the opportunity of growth. And when they do that, they get 30% income tax relief off their tax bill for the year. With the EIS, you can carry back to a previous year. So, for example, you can offset it against income tax in your previous year. For VCTs, which I'll focus on now, they work on the current tax year. The tax year you're in is the tax year you get the relief on. And what I've seen, and Chris, you probably back me up on this, is that a lot of people, or some high net worth individuals, are using these as a mechanism to start to build up a pot that gets them tax relief over a series of years, and it's long-term planning. So you can invest anything up to £200,000 in a VCT in a tax year. Obviously, you get the 30% income tax relief when you do that. But what we're seeing is people doing it at a much smaller level. So they might have used their ISA allowance and they might have max funded their pension. So now what else can they do? So we've seen people that take 20 grand as like effectively an additional ISA allowance, but then they use that £20,000 to put it into a VCT. And they do that over a cycle of 5 years. So 20,000, 20,000, 20,000, 20,000. And then what it allows you to do is when you get to the end of the tax, when you get to the end of your 5-year period of having put five lump sums of 20k in, you can then roll your first year into, sell that down and reinvest that into a new VCT for your 6th year. So you're effectively then recycling the tax relief that you'd get. So one, it gives you the ability to get tax relief on the same money. So you get 30%, so on 20k you get £6,000 tax relief on the way in. But it also allows you to build up a fund there that's going to be paying tax-free dividends. So most of these VCTs have an aim, it's not guaranteed, to pay 5% dividends a year. So it can also provide you with a really nice way of generating a tax-free passive income. And this is a bit of a place where I definitely recommend getting some advice on, because there are a lot of different providers out there, and we do a lot of due diligence on them to make sure it's right for each individual circumstances. But if anyone does want to help with that, we're happy to help and kind of assist people with a review of that, even just telling them whether it's right or not right for them.
What about, Craig, just with that, some people might be thinking that whether capital's at risk, and I'm assuming there is a risk on capital here, it's not guaranteed. But what sort of results are you seeing?
Yeah, so there is definitely a risk on the capital. So, for example, with EIS investments, there's no guarantee, and those, although you have a holding period of 3 years, they're locked in pretty much. So you're either waiting for a company to do really well and have an exit, or go bust. And if they go bust, then you get a loss relief on the money that's lost on the EIS. On a VCT, the way that they're structured is it's a portfolio of different companies, young companies that are higher risk, but you have the ability with the VCT to actually buy back. Most, not all, VCT providers will offer the ability to buy back the shares off you, so you've got a bit more flexibility, although you have to hold it for 5 years in order to get the tax relief. But does that address the question you wanted?
Yeah, I was quite surprised with VCT when you look at the planning side of it. It's quite neat. And the other side that struck me is that when you see these investments, people think they've got to put large amounts in one go. It's high net worth is 200,000 a year, and actually speaking to the providers, it's 5, 10, 20,000 pounds happy to do, and you look to do a regular amount and again recycle. It's quite a sensible structure. Definitely,
and if you think about someone's typical portfolio, they're going to have ISA investments which will be invested at a certain risk level. Then they'll have their pension, which will be invested at a different risk level possibly. And therefore, if you're doing smaller amounts of investment, your overall portfolio can tolerate a slight higher amount of risk. And that's where these can fit in nicely to, one, get tax relief, but also add a bit of value and a bit of punch in the portfolio if it's right for you.
Yeah, the other bit I did note actually when we had a conversation before, Craig, was some clients thinking they'll go to the providers direct on this, but I was quite surprised that it's cheaper to go through VK or Wealth essentially.
Yeah, definitely. So a lot of the VCT providers will want people to have advice. So if you went direct, I mean, I'm not going to name any companies, but I know that there's multiple companies that work this way. If you went direct, they might have a fee that's quite high, like let's say 5.5%. But if you went through an advisor, that can actually be discounted because they're trying to make sure that the people that are going into these investments are right for those type of investments, and therefore it allows you to get in at a cheaper cost if that's right for you, but also make sure you're getting the right advice.
All right, thank you for that. I just add my tax hat on, as it were. EIS, extraordinarily complex, the provisions there. There's so many ways that you can fall foul of the anti-avoidance in there. So always seek advice when you're looking at either structuring an EIS company or an EIS investment. And we should also mention for completeness, yeah, absolutely, 30% income tax relief on the way in, CGT free exit, loss relief if unfortunately the investment goes bad. There's also the baby EIS, CDIS, which gives you a 50% income tax break on up to £100,000 per annum. So very, very valuable tax breaks there. And we'd be happy to assist you further, either from a tax perspective or, as Craig and Ed said, from an investment perspective. But let's move on. We touched upon this, savings accounts. Not much out there really as far as returns for investors. Thoughts, chaps?
Yeah, I mean, it's a tough market at the moment, the cash market, but there are some players that are trying to shake that up, and one of them that we work with is called Flagstone. So anyone can Google that and find them, and if they want help with it or want a demo on how Flagstone works, we can always show that. But effectively what it is a cash management platform. You only need to complete one application form, and then it allows you to open accounts with I think at the moment on their panel they've got 40 different banks. So you can then flick in between different bank accounts without having to go and open an account with that bank. So where that provides opportunities, you might have these challenger banks who are offering a nice rate of return, but you don't necessarily want to go and open a bank account with them and deposit loads of money. So it allows you to then have access to those without the need to go and knock on their door and open an account. It also gives you the benefit to kind of spread your FSCS protection, financial services compensation scheme protection. So everyone's eligible for £85,000 per individual per banking institution of protection. So if that bank went bust, you're covered for £85,000. On a joint account, that's 170,000. And for a company as well, just to note, that's 85k. So the Flagstone cash management platform allows people to open, for individuals, you can open an account with a minimum balance of £50,000 and deposit that across all the different banks. And for a company, it's 250k. But for me, I think the real benefits of something like this is the ease that you can switch your money and move it back and forth, and the ability to spread your risk.
Okay. All right. Thank you for that. I think we will now talk about employment and points to consider. And I think, Chris, you're going to take us away here.
Yes, this is really going back to one of the key bits, going back to the NIC increase and the levy coming in. It's not just about that, but just in general, salary sacrifice is still out there, whether it be through pension or, as we got linked up on there, a good route at the moment, electric cars. We're all being pushed down the electric car route. And really a salary sacrifice arrangement for electric car, if you're an employee, take a salary, you can forego some of that salary to put into a pension, or to essentially put towards the cost of a car. And there's NIC benefits. If you don't pay the NIC, because you've reduced your salary, you're obviously reducing your tax exposure. And equally, the employer is receiving relief on employers' NIC as well. So typically, if you're out there and you're the employer, you might want to be looking at trying to push individuals, your staff, down this route and offer a salary sacrifice arrangement, because you're going to have the reduced cost as an employer. and obviously from an employee, it's beneficial for yourself as well. It's an easy win, shall we say. The other bits on there, obviously tax-free childcare, being mindful of higher income child benefit charge, those that do breach the it's now 60,000 mark, where you're starting to repay your child benefit. Again, it's looking at arrangements to potentially get that back.
What can we do there, Chris?
Well, I mean, one of the ones we haven't got on there actually is gift aid. Gift aid is something you always look at. Whether you've got they call them the CAP accounts these days, you can make a gift aid contribution and effectively carry it back if you haven't submitted your return. So there's options, I think is the point. If you're well over the limits for the child benefit, then it's not worth looking, but marginal rates over, it's worth looking at. I think, one of the bits there, so I've mentioned the electric company car a few times. We've done a few projections on this, and there's some really neat planning tools out there actually with this. So even where the employer, if you're an employer out there, thinking of offering this to employees for maybe staff retention, actually recruiting individuals being able to offer it. There's a lot of schemes out there where there's no cost to the employer on this at all, so no additional cost. So i.e. employee leaves or they get fired after a period of time, normally the car would go back and you'd have to pay a lease charge. On this, there's no cost. So there's again some really nice, interesting routes there.
And remind us what the benefits in kind rate is for low emission electric cars.
I think now we're at 2%, remember rightly. So again, it sort of comes into the fold of it that it's a very cheap benefit to have.
Okay.
And definitely, if you are looking at getting the electric car, speaking to an employer, it makes complete sense. You'll be surprised at the cost saving. And the other bits on there, we've got the review, obviously review healthcare insurance for those owner managed business out there. Relevant life cover, it's an absolute no-brainer. We do see a lot of businesses that surprisingly don't have this. They have traditional, or the individuals have traditional life insurance.
Sure. Yeah, I mean, just to jump in there on the healthcare side, so the private medical insurance front, it's one of those things, a bit like car insurance. A lot of people leave them there and have the insurance and don't review it. And let's say you haven't claimed on it. You can actually just get that cheaper by doing a review of what's open on the market and switching provider. So we see a lot of benefit by people approaching us just to say, can I have a review of it? And we get a nice cost saving from that perspective. And on Relevant Life, and it's a great way of providing a benefit to your family, especially if you're a director of a business, that your company can effectively fund the premiums, gets corporation tax relief on those premiums. It's not a P11D, so not a benefit in kind for the individual, and the lump sum payment on death is completely tax free to the beneficiaries. So for me, it's pretty much a no-brainer for anyone who's got dependents and is running your own company.
It's quite high multiples, I remember as well, isn't it?
Yeah. So the standard kind of death in service scheme, which is what it effectively replicates, you're looking 3-4 times salary. Where with these relevant life policies, you can get up to 25 times what your income is.
Yeah.
So certainly worth considering. Okay, one of the key tools though in our tax planning box is, of course, pensions. Still very, very tax efficient. Do you guys want to expand upon that high level summary for me?
Sure. I mean, they're definitely a tax efficient way of saving. I mean, we touched on the loss of the personal allowance earlier. So anyone earning over £100,000, their personal allowance starts to reduce £1 for every £2 you go over that. So effectively, by making a pension contribution, you've got the ability to kind of claw some of that back. So let's say you had a salary of earnings of 125k. By making a pension contribution, you could effectively bring your income back to the 100k mark, whilst also saving for your future, and effectively could save yourself 60% in tax, because you get the 40% tax relief plus the personal allowance, which you can regain. Now, it's a bit of a minefield in terms of what you can contribute into a pension. The rules around the annual allowance have changed multiple times over the last few years. And that's where we definitely recommend just getting some advice. But one benefit that there is with the pension contributions is you've got the ability to carry back to previous years. So, for example, let's say you not contributed to a pension for a number of years, but you had one, then actually you could start to build your retirement savings back up by contributing. You know, if let's say you've not made any contributions, you could contribute in theory £160,000 in one go. And if your company's making that, the 100% of earnings rule doesn't apply. That only applies for personal contributions. But if you're looking around tax planning, what would be a really key thing to look at is not what you're going to lose in total, but what will you lose when we enter this new tax year. So you've got to fill your current year's allowance, 40,000, but you're about to lose your furthest year, the 18-19 tax year allowance. So that 40,000 from that year could be lost. So just by making an £80,000 contribution, you could get that back. And obviously those numbers will all vary depending on someone's circumstances as well. But we can run calculations for people if they want us to help with that. Don't know if anyone's got anything else to add on to that.
I mean, it's proven it's still a very efficient, tax efficient plan. So I wouldn't discount. A lot of people don't have a flavour for pensions. I'm going to talk about property, but I think as a part of retirement planning in general, it would be foolish to not take up the option given the relief that's built in. I mean, we surprised as well get a lot of should we say older clients that think they're beyond and they're not going to be able to obtain any decent pension. They haven't contributed in younger years, and they easily miss that they're nearing retirement. And of course, we're looking at tax-free lump sums coming out. So going in, getting relief on entry, and then getting relief on exit within a few years.
Yeah, I think also on the basis a lot of people still think pensions are very inflexible, and with the rule change that came in 2015, the ability to actually access the lump sums and choose your own income.
Yeah. Okay.
Let's push on, guys. There's a quick point about turning 75. I think we just wanted to cover off there.
Yeah, just make sure if you are turning 75, it is your fund will be subject to a lifetime allowance check. So if you're anywhere near the 1,073,000, there could be a tax bill to pay at that point in time. And you also need to take your tax-free cash by 75. Otherwise, you can't take it out. So just be aware if you're getting close to 75, it's an absolute review point.
Okay, thank you for that. All right, we've been focusing on income so far. Geraint, let's just turn our attention to CGT, rates, allowances, and some planning there.
Of course. Right, CGT, pardon me, hasn't changed a great deal over the last few years. We're basically still looking at 4 rates, which is 18% and 28% for private equity gains and residential property gains, and 10% and 20% for all other gains. Those 2 rates depend upon how much of your basic rate band remains unused in the year. Now, there's also what is now called business asset disposal relief. I mean, most of us will remember it as entrepreneurs relief, which has, strictly speaking, been abolished and been replaced by business asset disposal relief, which effectively does the same thing, but it limits the available gain to 1 million, on which you would pay 10% tax, and then anything subsequent would be at 20%. And that's for the sale of trading companies that you own more than 5% of and have jumped through various other hoops, all of which can be easily arranged with a bit of planning. Now, there are certain options available to a plan around capital gains tax. As you'll be aware, you have a capital gains tax exemption of, I think it's £12,570 this year. Now, unlike the personal allowance, that does not taper away when your income goes above 100,000. That is always there. So it's well worth using, and you can use it in a number of ways. You can see from the next slide when I think one might be the previous slide actually. When
we've jumped ahead, but yeah, we'll go back to bed and breakfasting now.
There's what's called bed and breakfasting. If you recall, this used to be very popular and used to be basically selling a chunk of your shareholdings or your assets before the year end to use up your capital gains tax allowance, and then to repurchase shortly thereafter. Now, Gordon Brown, in his infinite wisdom, didn't like that, so introduced a 30-day gap that has to exist between the sale and the subsequent repurchase, by which time the market might have got away with you. If you do repurchase within the 30 days, the sale and the repurchase get matched together for CGT purposes, so it doesn't really wash out any significant gain. But there are certain ways around this, and I don't know whether...
Yeah, definitely, I can jump in here.
Yeah.
So we see it quite a lot where someone might have an investment account and it's accrued gains. And what we'd look to do is sell down enough money within their capital gains allowance and then shift those funds over. For example, using their ISA allowance, so £20,000 probably wouldn't generate the gain of 12,300. So you can take money from a non-tax efficient environment, move it to a tax efficient environment. Another example that I've seen, a client has £20,000 that he keeps as a cash reserve, but doesn't want to use that, but he's a high earner and he's got an investment account. You know, you can sell down from your investment account and then fund that money into your pension, getting the income tax relief and bringing you back down, regaining some of your personal allowance possibly, but also realising that those gains within the allowance is tax free.
Yeah, there's other. This is all, I think, fairly standard within DFM. With the that's what managers do. But your general investment accounts, correct. Individuals out there that have got a holding, it's basics that they could look at.
Yeah,
I mean, is it over technical for an individual? I mean, we've got their bed and spouse. I mean, that's probably as easy as you can get. Sell from one and buy back as the spouse buys back. That's quite easy to do. Bed is something similar, as we've called it. That's the sell Pepsi, buy Coke scenario. So you buy something, sell one off and buy it. So again, I think for the general investments, that's quite easy to do.
I think the one thing we see a lot with people who do self-invest into investment portfolios that are not wrapped in a tax structure is that they end up accruing loads of gains and not actually managing that over time. And then they come to a point where they need to get the money out and they've got a huge tax bill to get that out. So if you can manage it over time within each tax year, you kind of help yourself in the long run.
I mean, there were a couple of other things we can talk about in terms of the planning surrounding this. I mean, as I mentioned a little bit earlier, capital gains are taxed at either, take a vanilla example, 10% or 20%, depending upon the available basic rate band that you have. So you could, in some circumstances, make pension contributions to reduce down the effective tax rate that's going to exist on any gains. Another issue worth bearing in mind is interspousal transfers. As you'll be aware, no doubt, interspousal transfers take place on a no gain, no loss basis. So one spouse will effectively inherit the base cost of the other spouse. So gifts between spouses can be quite tax efficient. And there's a reference there in my notes, at least if not in the notes there, to what's called Form 17, which those of you who are tax specialists will be aware of, which is basically a way of changing the income allocation from rental properties between spouses. So if you've got a married couple, the default position on a jointly owned property is that any income is owned 50-50. However, if the underlying beneficial ownership differs from that, so it's actually owned 25% by one and 75% by the other, you can elect for the income tax on the rental profits to be taxed in those proportions. It does involve a bit of work, and in these circumstances, to kind of loop back into the CGT, you could have on a jointly owned property owned 50-50, you could have one spouse will gift 25% to the other spouse. So one would own 75% and one would own 25%, and then all subsequent income and capital gains would be in that proportion. So there's lots of playing around that can be done here. So once again, it's just a question of planning on a bespoke basis. Okay,
so we've already sort of touched property, and we've talked about a couple of the points on there. Just flag up one of them. Don't forget the 60-day reporting for CGT on UK residential property and payments to HMRC. From a financial services perspective, though, a couple of words on equity release, chaps.
Yeah, for sure. Equity release used to have a bad name in the market, but it's extremely regulated now. And with that, what we've seen is an influx of new lenders, effectively, which is for the benefit of people who are trying to take out an equity release. It's increased the number of providers they can go to, but it's also made them be more competitive. So we've seen better products out there. Pretty much every product has a no negative equity guarantee. So the risks around it have massively reduced. And what we're seeing is people using it for the purposes of, let's say you've got your main residence and you've been living there, but you've paid off your mortgage, but your children are now looking to get onto the property ladder. We see people using equity release to take money out to help their kids get onto the property ladder, because that's hard for people these days. Other things we've seen are clients that have got interest-only mortgages that are coming up to the end of their term, and they're not really sure how they're going to repay that interest-only mortgage and don't want to move out the house. So they effectively can take out an equity release mortgage and use that to pay back their interest-only mortgage and not have a term on it, so they're not then restricted by the term. Other examples are that you can use it for, to improve your retirement living. Some people want to just use their money to spend and live the retirement they need.
So there's just one point on the equity release. You can choose to pay the interest if you want to, if you don't want that to roll up and reduce the overall value of your property.
Yeah,
it's up to you.
It definitely works in that way. So there's different mechanisms of using it, and the products out there are really flexible these days. Some allow you to switch between the two options, but effectively you can pay it like an interest-only mortgage, or you can let the debt accrue within the property, and then in the event that you pass away or move into long-term care, then that debt needs to be repaid.
And we've seen this as good actual inheritance tax planning as well when you run it through. It's not in every case. I think you've got to be in a certain age category really to benefit from this.
Definitely. So this is probably really only for anyone over the age of 55. You can't even touch the products unless you're over the age of 55. But to touch on your inheritance tax planning point, let's say someone's got an estate that's over £2 million, or let's just say they've got a property that's worth £2.5 billion. By them taking out an equity release mortgage of £600,000 and gifting that to their family and living 7 years, then what they've actually done is brought their estate value down below the 2 million, and then they get the additional residence nil rate band back, so that there's an automatic tax.
But of course we can insure against the gift as well, so when we say gift is 5-7 years, we can also equally do the insurance to potentially cover any IHT exposure as well.
100%.
Yeah,
Okay.
It's very neat.
All right, thanks, chaps. I'm mindful time is marching on. We did mention incorporation of a property company or family investment companies. We have previously done a webinar on family investment companies, so happy to refer you to that. As far as incorporation property portfolios, just bear in mind you need to consider both the capital gains tax and probably arguably more importantly the SDLT implications there. There is planning we can do. There's lots of recent case law. The Ramsey case discussed whether owning a property portfolio was a business and gave you incorporation relief for CGT purposes. There is certain planning we can do around the SDLT, particularly if you hold the properties in a partnership and a family partnership rather than as an individual. But we'll move on now, since we've already started touching upon IHT. Let's just remind ourselves very quickly of some of the reliefs, etc., that are out there, Geraint.
Absolutely. Now, I mean, inheritance tax does get a bad rap. And maybe it's sometimes more productive to regard it as an incentive to make gifts earlier in your life rather than to cling on to everything until you finally pass away. So there are various annual exemptions that are available to people to gift money out of their estate that have absolutely no tax implications whatsoever. They're effectively what an old colleague of mine used to call a tax nothing. So each person is allowed to gift £3,000 to anyone they like, and it is not a potentially exempt transfer for inheritance tax purposes. And you're also able to carry that relief forward 1 year as well. So if you do nothing in year one, in year two, you can actually gift £6,000 down. So a married couple could actually give £12,000 in 1 year if they wanted to gift down to a child or spread it between a number of children. There's also a kind of small gifts exemption where you can gift small amounts of £250 or less to as many people as you want, other than the ones to whom you've gifted the 3,000. And that's also not an IHT-able event. It's not a potentially exempt transfer. What is quite interesting is the normal expenditure exemption. What this basically says is that if you make gifts and they're in some kind of a regular pattern, and there's a kind of vague commitment that they will go on like that, then as long as they don't deplete your capital, then they are not regarded as being an IHT-able event. So to take a very vanilla example, if you have annual income of £50,000 after tax and you only spend £40,000, you could gift £10,000 as normal expenditure out of income, and that would not be IHT-able. What is quite interesting here, this was pointed out by the late lamented Peter Twiddy of the Capital Taxes Office, was that there is no cap on this. If you were an ultra high net worth individual, you could gift 10 million a year, every single year, if it was normal expenditure out of after income, and that would be no problem at all. The Capital Taxes Office they said on many occasions they're aware of this, they don't like it, but at the moment the rule does still allow you to gift as much as you like, as long as it's out of excess income.
Okay, and what about gifts to ISAs, chaps?
Yeah, well, you've also got the ISA allowance, but the other one alongside that is pensions for children, which is often missed out in planning. You can do a gross contribution of 3,600, which automatically gets the tax relief at 20%. So the 2,880 sits quite nicely in the £3,000 a year under exemption, or as Gary already said, if it comes out of normal expenditure, it's not a problem, but you get the 20% tax relief. Even if you're maxing out your own pension and you've got 2-3 children, you can pay as many times as you want, provided you've got the cash to do so into children's pensions. It's a really good way of moving funds out of your own estate, but also building up a nice pot for your children for the long term.
So win-win. Okay, we're into the last 10 minutes, chaps. So let's just try and pull some of this together by way of an example. I'll read the question for you all, so you guys can pause for breath. So Mr. Owner, he's 58, self-employed, income of 145k, and he's been very happily married for 35 years. His good wife, Mrs. Rona, she doesn't work. She looks after the grandchildren. They've got savings of around 100 grand. And Mr. Rona gets about 500 quid a year of interest on that. Not bad based on current rates. Share investment portfolio, also worth 100 grand, and he gets approximately 4 grand of dividends a year from that. And the two of them jointly let a property. It's worth £300,000. It's mortgage free, and that brings in a pricely sum of £10,000 per year profit. The home's worth £1 million. And Mr. Owner, good for him, would like to retire in a couple of years, age 60. Small pension pot, but he's been a bit lax and hasn't made any contributions for a wee while. So, not untypical, I suspect. How are we going to help Mr. and Mrs. Rona, team?
Yeah, I mean, it's quite a typical case. I think, obviously, first thing we look at, seeing whether we've got any spousal exemptions, transfers, etc., splitting income. The obvious on there, we've got a bit of property, we've got the share portfolio, we've got a neat £2,000 allowance on the dividends each year, so straight away there, by moving the investment portfolio into joint names, we can utilise the dividend allowances there. Property, I think we could probably look at, there's no mortgage on the property, so we don't have an SDLT issue in moving. As long as Mrs. is going to receive the income, moving a bigger percentage into Mrs.'s name would be an obvious.
Could you use a declaration of trust there?
Yeah,
as well.
Yeah, indeed. I think obviously pensions coming back into it will be a clear consideration. They haven't been made for a number of years, so it could even be pensions for Mr. Owner or Mrs. and children, grandchildren as well could be considered.
I think as well, if you look at that, his income's 45,000. So if he's got the ability to carry back through his 3 previous years allowance, he could actually make a contribution of 36 grand as one lump sum, get the income tax relief, but also regain his full personal allowance.
Yeah. I quite like that idea, as we touched on before, the VCT route. It seems there's income there, whether it be from the savings, maybe do a regular VCT route that goes in.
Yeah, and that could increase some passive income possibly from the tax-free dividends there.
Yeah.
I mean, he can eat into his unused pension relief on a year-by-year basis, because the way it works is you exhaust your current year first, then you go back to the earliest year of unused. So you could do that over 3 years.
Yeah.
Effectively, so do 80,000 a year over 3 years.
Definitely.
And then wipe out all your back unused relief.
Yeah.
I guess from an IHT point as well, where we've got potential for equity release. We may be a bit too young at 58, but there are children and grandchildren there. So
yeah, potentially they might want to use some of the value in their property to look after the grandchildren, either pay for their school fees or when they're a bit older. Well, I don't know what age they are on this example, yeah. But then get them on the property ladder.
Yeah. What about, just out of interest, the one thing we haven't looked at was the maybe BPR shares, if we're currently holding them, and how easy is that to flip?
Yeah, I mean, so if somebody's got a share portfolio and they're worried about inheritance tax, you've got the benefit of business property relief, which effectively says that if you hold an asset that benefits from business property relief for 2 years, then it's exempt from inheritance tax. So we see that quite a lot of people will use investment portfolios for that purpose. They might be worried that they won't live 7 years, but probably not apply to this chap. But they'll use that money to effectively not have to worry about the 7 years, but only a 2-year period. The other benefits, if people have got ISAs, stocks and shares ISAs, they can do that with the stocks and shares ISA. So it's still in the ISA world, but then benefits from business property relief by investing in things on the AIM market, as an example.
There are firms out there that specialise in kind of collective investments,
yeah,
that just pick out the good stuff on AIM, because there's a lot of suspect and not quite so good stuff on the AIM market.
And that's where it's really important to get good due diligence on it and advice.
Where do we stand on this if we have the self-employed individual, wife that doesn't work, but going into partnership and having wife there?
Could go into partnership together. I mean, if the wife is actually contributing anyway to the self-employment that that Mr. Owner is doing, then it would not be unreasonable to pay her a salary commensurate with the work that she does.
Yeah, or a profit share.
Or a profit share. Yeah, easily slice in, maybe if she's an employee beneath the national insurance threshold, but at a point that will get her an NI stamp for state pension purposes, but doesn't create any liability.
Okay, guys, I think you've passed. We've summarised the points on the next slide. I think, look, I'm not going to run through them all. I think the point we would add is this is all solid, sensible tax planning. None of this we would regard as particularly aggressive. We're not, and never have been, in the market of selling tax schemes, etc., etc. We don't recommend them, but all of these points we should think about, even in a relatively simple scenario like this, with a family with a significant amount of income. Those sort of planning techniques do work, and we need to consider before the year end. So with just a couple of minutes to go, again, I'll just quickly cover off some of the IHT ideas. I think we've touched upon all of these. Equity release to allow you to free up capital to gift to the family, making pets, gifts from excess income that Geraint's talked about, BPR we've talked about, annual and one-off gifts, charity contributions can also be IHT efficient as well. So there's plenty in there. But to finish off, Geraint, sadly we do have to think about wills. Do you want to give us just a quick heads up here?
Yeah, very quickly, wills are important. If you die without a will, you are dying what's called intestate, and you might find that your monies do not go to the people that you so wish them to go to. And I've seen some absolutely horrific examples of this. So put a will in place, even if it's only a simple will leaving everything to your spouse. because she will not automatically inherit everything if you've got children. So it's well worth doing this. Get a will in place, think about who the executors would be, think about who the guardians would be should you be hit by a bus, or be you and your spouse both go down in a plane together. You need to consider maybe life assurance and things like that tacked onto the side to ensure that your family will be okay if the main breadwinner ends up dying prematurely. As we've seen on the notes there's other issues like head off family disputes. There's a reference to marriage. Bear in mind that marriage will annul a will unless the will was written in contemplation of the marriage.
I think one clear point there is we can help with wills.
Yeah, we can help.
This isn't go to your solicitor. This is, you can still come to BKL on this.
Yeah, come to BKL if for wills. Any IHT planning, we can integrate the IHT planning into the will, so you don't end up having to try to explain to a third party what your tax advisor has advised and get them to try to draft it. We can draft it for you to ensure that's all okay.
Thank you, Geraint. And on a related matter,
LPAs.
Yeah.
LPAs, lasting powers of attorney. Do consider these very carefully. There's basically two types. There's a health and a finance one. This allows someone else to act on your behalf should you become incapacitated. Well worth considering. If people can lose capacity quite quickly, in fact alarmingly quickly, and if you don't have them in place, the difficulty of going through the courts to get authority to act on someone else's behalf, even if they're your mum or your dad, can be very time consuming and very onerous. So if you're getting on a bit with more years behind you than in front of you, you might want to consider putting LPAs in place with trusted people who will act in your interests.
Thank you. So just to sort of pull all this together, thank you all for your time today, but think about, are you using all those allowances? And there's more than you may think about with all the dividend allowances, the small trading allowances, etc. What rate of tax you're paying if you're in that marginal band? Can we do something to get you out of higher marginal rate bands, particularly if you're in that 60% band, just over 100,000, be it gift aid, spousal transfers, pension contributions, etc. Use those tax efficient investments, be it ISAs. Think about, well, none of us like to, but think about IHT planning, wills and LPAs, etc., and try and get up to date with your affairs. And as we put there, that does include a review of your capital assets and the most appropriate structure for them. So we'd be more than happy to help you for any questions from a tax perspective. BKL Wealth Management can help you. Thank you, chaps, Ed, Craig, for coming along today. They can give you individual support, they can give business support, and they will do a complimentary review as appropriate. That's our little rogues gallery. What a handsome bunch we are, with all our contact details. So do feel free to get in touch. We'd love to hear any further thoughts you've got. We hope you've enjoyed today. Only, what is it, 3-4 weeks till the end of the tax year, so you need to move a little bit quicker than Harry Maguire did on Sunday. Do think about these points. If you can help us, if you need our help, get in touch. Apart from that, all it's for me to say is thank you, chaps, for your time today. Thank you all for listening. We'll be back next time. I think we're going to cover crypto, so something to look forward there. David, thank you for your help in our producer today. David will circulate the slides and a link to this webinar if you'd like to hear again, or if you'd like to pass it on to your colleagues. But for now, thank you very much and goodbye, everyone. All the best. Thanks now.
Thank you.
Goodbye.